Welcome to West Coast Wednesdays. I'm Mark Herzl, the District Manager here at A.N. Derringer in Los Angeles, California. The good news this week, the number of sea serpent sightings is at an all-time low, but there is still great risk when shipping, especially with international shipments. Now, let's talk cargo insurance, because carriers' limits of liabilities will likely cover your potential losses, and even if your Incoterms specify that another party is responsible for securing insurance coverage, what level of coverage did they procure to protect your liability? Now, compared to just a few decades ago, transit times have improved for all modes. They're safer and more reliable. However, risks remain. Cargo can shift inside a container, causing breakage. A leaky ULD left on a tarmac in a rainstorm could render a shipment worthless. Maybe an entire pallet of high-value consumer electronics shipments goes missing. Throughout the year, scores of containers get washed overboard by rogue waves. In another scenario, maybe your cargo is safe aboard the vessel. When it runs aground on a shoal, scores of containers were jettisoned to save the ship, but catastrophic damage was incurred in the vessel's hull. These are real examples of what happens more frequently than you would think. And without cargo insurance, your compensation for these losses is minimal. A multitude of international conventions and agreements and laws provide international and domestic carriers with limits of liability that can leave you with zero compensation for your now useless or missing cargo. For instance, under the Carriage of Goods by Sea Act, also known as COGSA, the limit is $500 per package or customary shipping unit. And under the Warsaw Convention, the most you can hold the international air carrier accountable for is $9.07 a pound or $20 a kilo. And in the case of catastrophic damage to the vessel, where general average has occurred, under this circumstance, did you know that even if your cargo somehow miraculously arrives unscathed through its port of discharge, that you must pay not only for other shippers' cargo lost at sea, but also for the repair to the damage to the vessel itself, which will be prorated based upon the value of their shipment on that voyage. Now, without cargo insurance, you have to post a bond and wait weeks to get access to your goods. With cargo insurance, you bypass this lengthy wait and don't have to post bond. We recommend that you secure cargo insurance through a logistics provider, such as Derringer. An all-risk policy is recommended coverage with minimal exclusions, and what this does is it gets you compensation for your loss unless it's one of the few delineated exclusions, such as damage due to inadequate packing or inherent vice. Now, the premiums for coverage under all risk really depend upon your commodity, your trade lanes, your loss history, but they're always well below 1% of the covered value. Now, if you don't secure all risk cargo insurance, we really implore you at the very least to procure general average insurance. The premiums for general average insurance are just a fraction of a percent of the value of the shipment. We hope that this information helps you to better understand how to mitigate your supply chain risks. Now, go out there and have yourself a great Wednesday.